Okay, let's just state the obvious. AI is everywhere now, right? I mean, it's in your clients' hiring tools, their marketing algorithms, their supply chains. But here's the real catch. Most of it is a total black box. It's just been deployed with little to no real governance or oversight. And for you in the insurance industry, that black box, well, that represents a massive unpriced blind spot. So that brings us to the most critical question for every single underwriter out there. What level of regulatory exposure are you actually underwriting without even seeing it? How can you possibly price a risk you can't see? This isn't some problem that's on the horizon. This is a reality that's on your books today, and it absolutely demands a new way of thinking. So let's talk about this unseen AI risk. This isn't just another variable you can plug into an existing model. No, it's a completely new class of liability, and it's already on your books, just quietly accumulating, whether you've accounted for it or not. Let's just put it side by side. Your underwriting process is fantastic at evaluating traditional risks. You know the drill: financial stability, operational hazards, historical claims data. But AI regulatory risk? That's a whole different beast. It's new, it behaves in ways we're just starting to understand, and it is fundamentally incredibly difficult to assess with the tools you're using today. And this is what makes this new risk so dangerous. For one, it's invisible to your standard due diligence. Two, it's unquantified, so there's no dollar amount you can just assign to it. And maybe most critically, it's already present in your client's business before you even think about writing the policy. It's a hidden liability from day one. And this quote really gets to the heart of the whole problem. Look, when you can't measure a risk, there's just no way you can price it accurately. And what does that mean? It means you could be underwriting millions in exposure without the right premium to back it up, creating a direct threat to your profitability and your stability. So, what's the solution here? How do you actually solve for this? Well, you have to make the invisible visible. The answer really lies in a new approach, one that's designed to find this risk, to measure it, and to translate this abstract regulatory exposure into something real, something concrete, a financial figure. And this is going to require a new kind of tool. A platform like AI Fine Protector, for instance, is designed for one fundamental purpose: to quantify that regulatory exposure in clear monetary terms, across key areas like the US, the UK, and the EU. It's built from the ground up to give you the number you've been missing. But let's be super clear here. This isn't just about spotting problems. You should think of it less like some passive compliance checklist and more like an active risk reduction engine. It doesn't just give you a score and walk away. It provides deep insight and, more importantly, actionable guidance to actually improve a client's risk profile. So here's a quick look at how it actually works. First, the platform goes in and identifies precisely where AI is creating regulatory exposure. Simple enough. Second, it quantifies that exposure into a potential fine, a real dollar amount. Third, it flags any processes that aren't backed up by evidence. And finally, and this is key, it provides clear, actionable steps to actually reduce that risk. Now, when you have this kind of capability, the entire dynamic just shifts. This is no longer about just defending against a new risk. It's about turning what looks like a complex regulatory challenge into a powerful strategic opportunity for your firm. So for you, as an insurer, this creates three immediate, frankly, game-changing opportunities. First, you get true pre-underwriting clarity. You understand the risk before you bind the policy. Second, you can give your clients specific guidance to help them improve their own risk profile. And third, you can offer this as a really valuable service, helping clients navigate something your competitors probably aren't even talking about yet. I mean, just look at the transformation here. Your underwriting process goes from being totally blind to AI risk to having genuine pre-underwriting clarity. Exposure shifts from being this unquantified mystery to a hard financial number. And the whole client relationship evolves because now you can provide clear, actionable guidance. It really does change the entire process, from top to bottom. And what this all boils down to is a shift in the entire conversation. You move from a reactive, defensive posture of risk avoidance to a proactive, strategic advantage. It lets you underwrite with confidence and create real, meaningful differentiation in what we all know is a crowded and rapidly changing marketplace. So let's start to wrap this up. AI regulatory risk? It's not some far-off hypothetical thing we might have to deal with someday. It is an inevitable part of the modern risk landscape. The question really is no longer if you'll have to deal with it, but how you're going to manage it effectively.
And make no mistake about it, this risk is already embedded deep in your client's operations. It is on your books right now. And with every new AI model they decide to deploy, that exposure is only going to get bigger. So, the existence of this risk? That's not up for debate. The only real question you need to be asking yourself is this: is it being seen? Is it being quantified? And is it being effectively managed within my portfolio? That's the challenge. But for those who act now, it's also a massive opportunity.